The subject of today's message is the truth about the Federal Reserve. The truth about the Federal Reserve. Before I read notes from that, I'd like to read a passage of scripture from the Hosea in the book of Ani, page 54, section number 7. Here's what it says. Small gifts return greater, and what is replaced brings abundance. The wise live off the house of the fool. Got that? The wise live off the house of the fool. Protect what is yours, and you will always find it. Be watchful of what you own, lest you end up as a beggar. One who is always idle amounts to nothing, but one who is diligent is honored. The biggest threat to America is a group of terrorists, but they're not Arabs. These terrorists are conducting something called financial warfare in America, and not only in America, in other countries around the world as well, possibly leading to a global financial meltdown. These terrorists are a small, covert, clandestine, London, European, and American-based organizations operating in the United States as a supposed government agency. All right. Notice I said a supposed government agency. They're called the Federal Reserve. The fact that the President of the United States, the Vice President of the United States, and every Senator of the United States, and every Congressman of the United States, they make it appear as though the Federal Reserve is a government agency, when in truth it is a private corporation. That's right. That's right. The fact that all of these politicians in Washington know this about the Federal Reserve should let us know that it is the most dangerous terrorist organization, and they're willing to go to any extent to control the United States government. I just stated, I'll say it again, the Federal Reserve is a privately controlled corporation. It is not a United States government agency. Check this out, y'all. Something called the Constitution of the United States. Article 1, Section 8 of the Constitution of the United States. Here's what it says. It says, Congress, and I quote, Congress shall have the power to coin money or create money and regulate the value thereof. That's what the Constitution of the United States says. It says, Congress shall have the power to create or make or coin money and regulate the value of it. Today, however, the United States is not making money. When I say making, I mean actually creating it, actually printing it. The United States is not doing that. Scratch that. The United States Treasury is doing it, but not for the United States. It's doing it for the Federal Reserve. Let me give you the history here right quick. The Federal Reserve began with approximately 300 people, or banks that became owners of the Federal Reserve System. They make up an international banking cartel of wealth beyond comparison. The Federal Reserve collects billions of dollars. What did I just say? Billions of dollars in interest. Not the principal, in interest. Every year, and what they do is they distribute the profits that they make off of this interest to its shareholders, which are rich white people in England. The United States Congress illegally gave the Federal Reserve the right to print money through the Treasury, check this out now, at no interest or cost to the Federal Reserve. Now, if you don't mind me, let me show you. Here you have this little entity over here called the Federal Reserve. Here you have an entity called the United States of America. And the Federal Reserve does not even have their own printing presses. They use the printing presses or the mint of the United States Treasury and makes the United States print up all this paper money that now becomes what is called Federal Reserve notes. Right. Don't take my word for it. Look at the dollars in your pocket. Right across the top, it says a Federal Reserve note. Now, that's some deep stuff, because the United States Treasury printed up this paper, gives it back to the Federal Reserve. The Federal Reserve now takes this paper and distributes it to banks all over America, and then turns around and charges the United States interest on every piece of paper that it hands out. Now, if you and I did that, we go to jail. But they'd lock us up in a minute, because we took something that didn't cost us anything to print, distributed it back to the people who printed it, and then we'll charge them interest on it. That's some deep stuff. And then after doing that, the Federal Reserve turns around and buys the debt with money printed on a printing press. And and notice how I'm saying that very intentionally. I didn't say we, I said you. 40% of your income tax return every year goes to pay the Federal Reserve the debt that they are now holding over this country. Who actually owns the Federal Reserve? Who owns it? I'll tell you. There are 12 central banks. Rothschilds. That word ain't in the Bible, Pastor. I know it ain't. That's y'all's problem. You've been so biblicized that you ain't know what's going on. The Rothschilds Bank of London, the Warburg Bank of Hamburg, the Rothschild Bank of Berlin, Lehman Brothers of New York. Everybody say your American Express card. That's who owns American Express, y'all, Lehman Brothers. Lazard Brothers of Paris, Kuhn Lloyd Bank of New York, Israel Moses Saif Banks of Italy, Goldman and Sachs, y'all heard of Saks Fifth Avenue, Goldman Sachs of New York, Warburg Bank of Amsterdam, and the Chase Manhattan Bank. These bankers are connected to what is called banking houses in London. Now, let me give you some more names here. First National Bank of New York, James Stillman, National City Bank, New York. Mary Harman, National Bank of Commerce, New York. A.D. Juilliard, Hanover National Bank of New York. Here's a name you might have heard before, Jacob Schiff. Yes. Yes. For those who don't know it, that's the man who started the NAACP, y'all. A Jew. He also started the Anti-Defamation League. A Jew, Jacob Schiff. Chase National Bank, New York, Thomas Ryan, Paul Warburg, William Rockefeller, Levi Morton, and y'all ain't none of these black folk. None of these, not one of these are black people. M.T. Pine, George F. Baker, Percy Pine, Mrs. G.F. St. George, J.W. Sterling, Catherine St. George, H.P. Davidson, J.P. Morgan, Equitable Life Insurance Company. Edith Greville T. Baker. These are your owners of what is called the Federal Reserve. They don't care about you. They have no interest in you whatsoever. Now, how did all this happen? How many of y'all have ever heard of President Woodrow Wilson? Yes. Well, just before his candidacy and his term as president, the Federal Reserve had been trying to manipulate themselves into the operations of the then known United States, even though it was almost bankrupt already. And what happened is a group of bankers, and see, this is how they do it. These rich folk who I just named for y'all, who all come from rich families, what they did is they funded the political campaigns of Woodrow Wilson and senators and congressmen who were in office at the time. What they threatened to do, and see, this is how they do it. If you act like you don't want to do what they told you to do, then they'll let you know we're going to put our money behind your opponent. Yes, yes. So you are sure to lose the next election. Yes. They don't want to lose, so what happened is during the Christmas break, a senator in 1913, his name was Nelson Aldrich. Come on, guys, come on, man. Everybody say Nelson Aldrich. Nelson Aldrich. Well, Pastor, who is he? I'll tell you, Nelson Aldrich was the grandfather of the Rockefeller family. Yes. The maternal grandfather of the Rockefellers. Yes. See, again, they're thinking down the road. Yes. Nelson Aldrich, being a senator, pushed the Federal Reserve Act through Congress during the Christmas break while much of Congress was on vacation. And when Congress came back from vacation, well, it was a law now. The Federal Reserve Act has been passed, and the Federal Reserve is now in charge of the money of this country. Then in the 1930s, the Federal Reserve started buying up the media. In case y'all don't know this, let me educate you here. The Federal Reserve owns ABC. The Federal Reserve owns NBC. The Federal Reserve owns CBS. The Federal Reserve now owns BET. Y'all getting this? Turner Communications, Federal Reserve, CNN, Federal Reserve. So when y'all listen to stuff on television, what do you think you're going to hear? What the Federal Reserve wants you to hear. There were some presidents named Lincoln, Jackson, and Kennedy. These three presidents decided to do something about the Federal Reserve's control over the United States. said we can print our own money. Lincoln died in a theater. Kennedy passed executive order to print our own money. Shortly thereafter, he died. You see, brothers and sisters, here's how it happens. When the government runs into a deficit, the Fed, the Federal Reserve, prints up dollars through the Treasury, buys the debt, and the dollars are circulated into the economy with interest on each note. How many of y'all remember the $2 bill when they came out? Y'all remember those? They weren't printed by the Federal Reserve. That's why on the $2 bill, it said across the top, United States note. A silver certificate, which was redeemable at any bank or Federal Reserve bank for silver in the amount of that particular amount. Y'all follow what I'm saying? Yes. In other words, the money that the government printed was redeemable for gold or silver. The money you got now, it don't say it's redeemable for anything. Right. Take it out and read it. It ain't redeemable for nothing. You think it's powerful because the Federal Reserve is allowing you to continue to use their notes. But if the Federal Reserve right now should cancel all those notes, you might as well use it in your fireplace. Right. Yes, yes. Because it will mean absolutely nothing. The Federal Reserve wants to see how many of y'all got their notes.
Here's a question for you. What do financial markets and used car markets have in common? Well, let's resist the temptation to conclude that both used car and financial markets are places where shady practices are common and where con men prey on regular folks. Used car markets and financial markets do have a lot in common. But what they have in common is not so obvious. My topic today is a concept called asymmetric information. Simply stated, a situation where one party in a transaction has more information than another party in the transaction. To introduce that topic, I ask you to consider a couple of facts about financial structure in the United States and the developed world. These facts are surprising and lead to three important questions. Fact: stocks and bonds are not the most important source of external financing for businesses. Fact: on the New York Stock Exchange, there are about 8,500 companies whose shares are listed and about 3,000 different corporate bond issues traded. But fact: the U.S. Census Bureau reports that in 2002, there were more than 7,200,000 U.S. firms with employee payrolls. So here are the three important questions. Why do so few firms use stock and bond markets to raise funds for investment, that is, for their capital development? While large, well-established corporations have easy access to securities market funding, most firms borrow funds through banks and other financial intermediaries. Well, then that leads to question two. What do banks have to offer that bond and stock markets do not? Now, earlier, I pointed out that banks were middlemen that offered valuable services to their customers. One of those services is the ability to deal with asymmetric information. Banks use a particular kind of contract when they lend funds. And as we shall see, the so-called standard debt contract provides an incentive for firms to tell the truth about their operations and about their profitability. Question number 3, why are banks so rigid in their loan practices? Standard debt contracts typically require borrowers to post collateral, and they may place substantial restrictions on how borrowers may behave after they receive borrowed funds. And to the uninformed, such bank practices sometimes seem absurd. Consider the frequent lament of a would-be borrower. If I had collateral, I wouldn't need a loan. An understanding of asymmetric information and the problems it leads to will help us understand why banks behave as they do. So, asymmetric information occurs when one party in a transaction has substantially more relevant knowledge than another. Often, the relevant knowledge is about the quality of the product being bought and sold. Let's start with some examples of symmetric and asymmetric information, and those examples will help us understand what sort of information we are talking about, and they'll also help us appreciate the potential importance of information differences. For many products and markets, it makes sense to assume that buyers and sellers have symmetric information, so that everything the seller knows is known to the buyer. For example, if the product in question is a pound of flour or a pound of nails, it's easy for the buyer, especially given labeling laws in the United States, to know everything they consider relevant about the product. Now, the seller may know the location of the flour mill or the plant where the nails were actually made. But for a product like flour, the information that buyers consider relevant is typically printed on the label. And as for nails, what the buyer wants to know is most often easily observed. It's a nail. But for many other products and services, it is clear that one party to the transaction has important knowledge that the other does not. The seller of a used car better knows how well that car was cared for, whether its oil was changed on a very regular basis, whether it had all the stipulated services. The buyer of health insurance better knows his or her health than the seller of the insurance. The buyer of health insurance knows whether they exercise regularly, knows whether they smoked, knows whether they went for regular checkups. And the job applicant better knows her skills and her work ethic than the potential employer. Nobel laureate George Akerlof is widely credited for first studying the impact of asymmetric information on economic markets and outcomes. According to Akerlof, asymmetric information leads to adverse selection in the marketplace. I'll explain. That's a situation that Akerlof described with the shorthand phrase, the lemons problem. Let's think about the lemons problem, and let's think about it in the context of used cars. The seller of a used car has more complete knowledge about the quality and maintenance of the car than the buyer. So, the buyer rightly assumes that purchasing a used car is risky. the car could be a lemon rather than what West Coast folks tend to call a cherry. The buyer will only buy at a price low enough to provide that buyer with compensation for the risk of buying a lemon. Potential sellers who have well cared for and well-running cars, cherries, will be less willing to sell them in the used car market because the price they are going to receive is less than the price for their car, their cherry. Because of asymmetric information, lemons will be therefore overrepresented and cherries will therefore be underrepresented in the used car market. The used car market is said to adversely select lemons. Put another way, there is a disproportionate number of lemons in the used car market and disproportionately few cherries in the used car market. In a sense, the belief that the used car market offers lemons to prospective buyers becomes a self-fulfilling prophecy. Now, Akerlof pointed out that the lemons problem actually creates a market failure. Out there are owners of well-cared-for cars, cherries, who would like to sell, and there are buyers who would be willing to pay a fair price for a well-cared-for used car. But given asymmetric information, welfare-enhancing trades between those two groups of people never occur. This is an important market failure. Keep in mind that what we're saying here is that if I somehow knew the car was a cherry, the buyer and the seller could get together and have a mutually advantageous trade. But the risk that the car is a lemon keeps that trade from occurring. Okay, now in recent years, entrepreneurs have found a way to make a profit for themselves by offering information that will level the information playing field. And CarMax and Carfax are two examples. If you buy from CarMax, you get a guarantee about the performance of the used car. If you purchase a Carfax, you get a statement about the history of the car. Both of those level the information playing field. Akerlof argued that the lemons problem affects job markets, insurance markets, and lots of other markets. Buyers of health insurance have an incentive to hide the fact that they smoke from an insurance company. But in recent years, the nicotine blood test allows insurance companies to affirm whether a potential insurance buyer is a smoker or a non-smoker. Some firms may prefer candidates with degrees from prestigious universities, not because they believe that those universities provided their students with superior skills or superior education, but simply because they believe that those prestigious universities did a good job selecting high aptitude students. What then is the relevance of asymmetric information for financial markets? Briefly stated, a potential borrower has more knowledge about how funds that are going to be borrowed will be used than the lender has. A loan applicant has an incentive to paint the rosiest possible picture of the investment project that the borrowed funds will finance. The lender is at a disadvantage because it will cost the lender something to gain even partial information about the project. And the problem doesn't end there. After the loan is made, after the fact, the borrower often has an incentive to understate the profitability of the project. And that would be true whenever an understatement would lower what the borrower pays back to the lender. Of course, the lender understands that it possesses less information and structures its lending contracts accordingly. That, indeed, is a big part of my point. It's important to realize that financial firms which lend face two different types of information symmetry problems. We've already talked about one, adverse selection. Adverse selection occurs before the lending transaction. And as the name suggests, the existence of asymmetric information selects participants into the loan market in a perverse way, the same way that the lemons problem adversely selected lemon used cars into the used car market. So, suppose economic data arrives suggesting that a recession of unknown depth and duration may occur within the next few quarters. Let's contemplate, in order to understand the asymmetric and adverse selection problems, how a bank might behave in this case toward its prospective borrowers. One possible answer, a very reasonable answer, would be that banks and other lenders would raise borrowing rates to compensate them for the higher risk entailed in lending in a higher risk economic environment. However, it may be unwise for a lender to raise its lending rates when it believes that investment projects have become riskier. Why? Raising borrowing rates may select higher risk borrowers into the applicant pool and exclude lower risk borrowers from the applicant pool. So that's one problem. The second asymmetric information problem faced by banks and other lending institutions is called moral hazard. And moral hazard occurs after the transaction. The existence of asymmetric information provides one party with an incentive to behave differently after the transaction than they promised to behave when they negotiated the transaction. Suppose, just by way of a simple example, that the managers of firms that may borrow funds receive bonuses that increase with firms' profits but never fall below zero, no matter how great firms' losses. Pretty reasonable. Managers then have an incentive to tell a lender, a bank, that they will invest borrowed funds in a safe project because that's the way to maximize the likelihood that their loan will be approved. Aha! But once the loan is approved, those same managers have an incentive to use the funds that they've received from the bank to undertake a riskier project than the one they proposed. If the project fails, the managers may receive no bonus. But if the project succeeds, they're going to receive a larger bonus than they would have with the safe project. And it may turn out to be a good bet for the managers to take on riskier projects. Because if the project fails, the bank suffers a loss, but the manager does not. That's moral hazard. Not surprisingly, I'm going to argue that the existence of asymmetric information explains the puzzling facts with which this lecture began. And I'm going to do so by explaining first the standard debt contract that governs borrowings by firms from banks. The standard debt contract. Why do so few firms use stock and bond markets to raise funds for investment? Well, prospective buyers of stocks and bonds realize that they can never know very much about the operations of a firm. They're going to provide funds, but they're on the short end of the information stick. On the other hand, if the firm is large enough, It will be profitable for analysts to study the firm and sell their findings to prospective bond and shareholders, leveling the information playing field. But imagine a small firm. This will not be so. It won't be worthwhile for any analytic firm to study a small firm because they won't be able to sell the information. There's not enough at stake. Prospective buyers of bonds and shares in a small company also realize that it would be easy for the company to understate its profits. And they understand that the managers of those small firms have an incentive to convert funds into bonuses and hidden compensation, turning dividends into costs. Is a corporate jet justified by the increased efficiency it provides to high-ranking officers of the firm? Can you tell as a stock and bond owner? Or is that corporate jet more like a tax-free bonus for the employees who get to use it? Again, moral hazard. Asymmetric information implies that adverse selection is likely to occur. The PE ratios of small company shares, therefore, will be low in order to compensate the buyer of stocks from the risk of owning a lemon company. Lemon companies will be therefore overrepresented in the stock market, and good companies that are small will be underrepresented. In fact, it may be difficult, if not impossible, for a small company to issue shares or bonds. Okay, so those small companies are therefore likely to seek an alternative source of funding, and we know that that alternative source of funding is banks. But what we don't know yet is what banks have to offer that bond and stock markets do not. There are several reasons why most companies find it advantageous to obtain funds from banks. Banks have designed a particular kind of contract. It's called the standard debt contract in the finance literature, and it's a very old idea. And the standard debt contract provides some relief against the problems of asymmetric information. So what are we talking about here? Well, in the standard debt contract, the bank does not share profits with the borrower, for the very simple reason that the bank realizes that it would be easy for the borrower to understate the true profits and hard for the bank to detect the understatement. Instead, the optimal debt contract allows the borrower to declare only two states of the world. In the first state, the borrower reports that the borrower is able to repays a fixed interest and principal. The lender receives the same interest payment no matter how successful the project was in the first state of the world, so there's no need to monitor how successful it was. And the lender will not pay to monitor the success of the project in this state of the world. But in the second state of the world, the borrower says something different. It says, I cannot repay. If the borrower says, I cannot repay, the lender pays the audit cost to discover how much the project actually earned. Now, the project probably earned something, even though the borrower said it earned too little to repay interest and principal. The lender discovers as well as possible what the project earned and then takes all of that return from the project in partial compensation for the loan. The standard debt contract has two very important and I would say beautiful properties. First, The standard debt contract is a contract that makes it optimal for the borrower to tell the truth when the truth matters. We call that a truth-telling contract. The borrower either repays or says that she can't. In the latter case, the bank audits the project and takes all the available proceeds. It turns out that it's not in the interest of the borrower to ever lie. The second beautiful thing is that the standard debt contract is a contract that makes both the borrower and the lender better off whenever the firm's project is sufficiently profitable to justify a loan. So it leads to loans being made in the right cases where the projects that those loans will fund are expected to be sufficiently profitable so that it's mutually advantageous for the bank and for the entrepreneur. Okay, so we have an explanation of the preference by so many companies to borrow from banks rather than to try to issue stock or borrow in the bond market. But we have another question. Why are banks so rigid in their loan practices? And in particular, why do banks and other lenders frequently demand collateral and frequently place additional restrictions on borrowers' behavior? Well, it turns out that the standard debt contract is not a complete remedy for the problem of asymmetric information. Even under a standard debt contract, a borrower has an incentive to promise the bank it will operate a safe project, and then, after the loan is granted, decide to run a riskier project. Moral hazard is still an issue. And remember, if the project succeeds, the firm earns higher profits. If the project does not succeed, the firm is no worse off than it would have been if it had run the safe project. For this reason, banks and other lenders understand that moral hazard is a problem, even under the standard debt contract, and they seek remedies. The requirement that a borrower provide collateral provides one of those remedies for the asymmetric information problem. Why? Well, the bank may be able to more accurately assess the value of pledged collateral than the bank can assess the value of the project that has failed. By posting collateral, the borrower provides the bank with tangible assurance that it will use the funds as it promised to use them. And to the extent that the collateral has a value greater than the borrowed amount, the lender no longer suffers from an information disadvantage, and moral hazard will not rear its head. But we know that lenders do more than demand collateral. They frequently impose restrictive covenants on borrowers. Home mortgage loans require the borrowers to maintain homeowners insurance on the property. Auto loans require the borrower to maintain property insurance on the vehicle. And homeowner loans frequently forbid the borrower from renting the property to a third party. So, how is a bank loan like a used car transaction? As we've seen, both suffer from the problem of asymmetric information. The seller of the car knows more about its quality than the buyer. The borrower of funds knows more about how the funds will be used than the bank. This is why very few firms can obtain funds from stock and bond markets. Asymmetric information makes profit sharing risky for the parties who know less about the firm's operations than the managers of the firms know. Most firms, and the great majority of small firms, must borrow from banks and other professional lending companies. But wait a minute. What do banks have that provides them with a remedy for the problem of asymmetric information? Banks use a standard debt contract, which mitigates but does not completely eliminate the adverse selection and moral hazard problems. And to further mitigate those problems, banks design collateral arrangements and restrictive covenants. Yes, banks are middlemen. And yes, they are specialists. Banks specialize in assessing the creditworthiness of borrowers. Because their evaluations are private information, banks can profit from their expertise the way CarMax profits from its particular business plan. Now we understand a bit more on the value of services offered by financial middlemen, and in particular, those that we call commercial banks. In the next lecture, we will again use the concept of asymmetric information, but we will use it this time to understand why those same financial firms, and banks in particular, are so highly regulated by government. Thank you.
All right, family. All right, hope I'm coming in loud and clear. Loud and clear, loud and clear. Understanding asymmetric information, dealing with accounting in some instances seems to be fleeting. But I'm going to try to explain this in a way where everybody can get this. You should be seeing on your screen the United States debt clock. So I'm going to use that as a visual aid to break down what's obvious. A lot of you guys that are in Syntax Trust Mastery class who have gone through your arbitration classes with the American Arbitration Association have already onboarded with Go Capital being one of our lenders, and also North Avenue Capital. So I'm now going to bring it all home for those that are in that space to maximize in this training. I want you to take a look at this debt clock from this perception, because remember, all I'm offering is the truth, nothing more, nothing less. And if you listen long enough, you'll definitely learn something. At the very top of this debt clock, you see the United States national debt at $34 trillion. You see that out of that $34 trillion, they have broken it down to $101,000 per citizen and $264,000 per taxpayer. If you combine both of those amounts, it is well over $350K that, because you are a taxpayer or citizen, either or, they can easily say to you, because you're participating in this system, that you owe them 350 plus in the aspect of debt that's been created. The reason why you owe this is because you're not practicing proper accounting. Now, asymmetric information is designed to literally give you the intel that you should have. In the symmetric space, a lot of borrowers of capital don't fully understand how they're able to do certain things. They just know that by doing certain things, they'll get a certain result. So financial literacy has everyone in this mind state of what money is versus what it isn't. I am only going to give you the facts pertaining to what we can talk about in this open venue, meaning that it's a public venue, because if you're watching this on a YouTube, this is in a public space. I cannot go into proprietary processes behind what I'm explaining. If you want to know the intricacies of what we're talking about, then you have to enroll into our Syntax Trust Mastery course and then get that intricate asymmetric information from a private capacity so you can apply what I'm saying in real time. But for this training purposes, I'm going to not gloss over. I'm just going to make mention that there is an accounting principle that will allow you to do what we're talking about. So you heard Professor Salami talk about the standard debt contract. This is the ancient name. I'll use the ancient name. This is like one of the earliest names of what became a loan application, a standard debt contract. Now, today's version of a standard debt contract has within its framework asymmetric information that breaks down into insurance. The insurance breaks down to the lender as assurance. So the data that's put on the standard debt obligation contract presented in an aspect of accounting provides assurance. And this insurance is in 2 states. You heard him break down the 2 states. One state deals with the fact that the borrower is able to repay. So that is the assurance that they see when they're putting a certain level of math and accounting in that capacity. The borrower has the ability to repay. The information on the contract provides an ability to repay. Here's the contingency for the lender, and this is in the 2nd state. If the borrower cannot repay, the lender now gets to exercise a clause to discover the value of what they've lost, and they are utilizing commercial processes to recoup that value through the reinsurance mechanism. This is why we teach compliance officers to structure these deals where the first prong test is, can this be insured? And it can be insured if adequate information is given, which will provide the lender with assurance, such as a surety, a bond, insurance. Bonds and insurances are the easiest, in my opinion, to collateralize. In our training today, we will get into a lot of intricate decisions and discussions about what does that collateral looks like from an M3 perspective. We teach this to compliance officers in order for them to be able to use the rules of Uniform Commercial Code to provide that remedy. So potential borrowers have a whole plethora of information that they can take advantage of, but in order for you to take advantage of it, you got to be able to be in the right frame of mind to receive the information. It's insurance and reinsurance. That insurance gives the lender the confidence to know that that potential borrower can repay. Now, the lender, when they discover what the value of that project is, they kick in their arbitration clause, they kick in their right of indemnification, and they leverage that project that didn't produce fruits into another mechanism which will make up the difference of what they've lost. So I'm going to give you a rule. I'm leaving certain information out on purpose because I don't want to get a new person in trouble. I want them to simply research what we're talking about from an insurance, reinsurance standpoint. I want them to really get the gist of what an M3 asset is. And then once they get that framework, now they're ready for the accounting principles. Now they can step into the proper roles to implement. And we do have qualified individuals and entities to suffice and step into that. And if you want more details, give us a call at 561-873-2125, and someone from our illustrious staff will get back with you as soon as possible. Understanding this information, now, okay, the debt is on the left side of the debt clock. We're going to say that this side of the debt clock is the credit side. So everything past this line is the asset side, okay? We'll say the credit side, debit side. We're going to say liability side, equity side. We're going to say this is the public debt. This is where the private remedy is. I'm trying to take you somewhere if you just listen. You got to listen, not talk. Listen. Because if you listen long enough, you'll learn something. This is a T account. Everything over here is credits that's owed to the government. Everything over here is how that credit is going to be debited. You have to figure out what this number is here and make it applicable over here. Now, I want you to come down. This is at the top right, staring at this debt clock. So you're going to come to the bottom. Let's back up. This is the top left, excuse me. So the left side, credit side, right side, debit side. Now I'm going to flip it around, because when you turn this opposite, meaning that I'm staring at this, so whatever you do on one side is going to be opposite. If I hold up the right hand, the left hand is going to go because I'm staring at it. I'm showing, you're looking at the debt clock, so you know how to turn it inverse to use it. Everything that you're seeing in this United States national debt clock, if you provide a remedy that starts with putting back into the United States COFR, if you will, the CAFR account, if you will, if you create a $350,000 credit that can be applied towards this debt, then you will be allowed these allowances over here. I'll repeat. It will be to your advantage to create a mechanism that overcomes this $350,000+ deficit. Once you apply that, in other words, once you put in a negative credit, that's going to bring it back to the estate, then you're able to do what we're about to explain, and we're going to use lenders to do this. The standard debt contract. The standard debt contract, that is an application. Like, I'm going to show you how they do this in your face, and then I'm going to show you how you do this from what we teach from those that are compliance officers, etc. And it's what you're already used to, is just different names, a different formula. I'll give you an example. This is tax season. So everybody's trying to get additional, quote unquote, in the public. Consumers are trying to get a tax refund. The reason why they're trying to get a tax refund is they want to go spend it back in the economy. Now, again, in accounting, getting a tax refund isn't a good thing. It's a bad thing, because that means you have screwed up on the math. Because you're not supposed to be getting a tax refund at the end of the year. You're supposed to be getting a return on your money every 30 days. Because debt ain't debt till it's been on the book for 90 days. So every 30 days, there should be reports going in. So in the next quarter, you should be getting that return. So when you don't get it, you're screwing up on the math. Accounting isn't adversarial. It's peaceful. Let me explain. All of these numbers here, starting with the dollar supply, you're going to see that the dollar supply is at a $502 billion negative. So there's a debit, a negative debit. If you hold Federal Reserve notes, you're in that negative debit zone. So if a negative debit, what does a negative debit do to your accounting? Does it increase your balance sheet or decrease your balance sheet? For example, if you have a credit in what we call the mind state of individuals that are in commerce, would you state that a credit, does a credit increase your balance sheet or decrease? There isn't a bad or good, there's a position. And it depends upon your financial literacy whether credits increase your balance sheet or decrease your balance sheet. So I'm going to pick one to demonstrate. I'm going to pick what most of my clients know, which is that credits decrease their balance and debits increase. Debits increase. So if they have a credit that they show, a credit equivalates to things that went out of the estate. That's why it's owed. You list it as a credit, so you show where it went, because credits are issued. A lot of people that call themselves secured party creditors don't get the fact that how can you say that when you're not demonstrating, recording, and reporting the credits that you have issued. So if you are in that zone that understands what I'm talking about, then your credits need to be reported in a ledger. Now, how do you recall those credits? Well, in order for you to get those credits that went away because a credit decreased, you got to call that credit a negative in order for it to come back. So understand that if it went away as a credit, somewhere in your ledger, you're going to have to recall it to bring it back. But you don't have to bring it back in this depreciable dollar supply like an M1, because that's what cash is, an M1. M2s are what we call checking and savings accounts. And then the safest one is what we call near money, which is M3s, which are made up of time deposits such as insurance policies, CDs, and they also have M2s, which is checking and savings accounts, and then M1s, which can be conveyed and converted into cash. And all of those conversions from a 3, which is going to be an insurance policy, to a checking and savings account, to cash can all be done with a bond. The bond that's used in most conveyances is called a money transmitter bond. So a money transmitter bond held by someone that has an M3 asset can issue that M3 asset to a recipient who's willing to pay for the liquidity of that quote-unquote asset to a 2 or a 1, and it only costs 1%. And this is where these lenders come in. See, these lenders will, listen to me carefully, they will totally disqualify you in one aspect or the other, meaning the software will say, we will fund your project tentative you bring this, and this. So it's not that your loan application has been denied. You need to see what was the reason for the denial. And that denial is going to be based upon showing your ability to what? Repay. And having adequate collateral allows that. But see, the data that they got, it didn't get enough to show that. So you're going to have to provide additional documentation. And the additional documentation is what the compliance officers, civil law notaries, and parliamentary draftsmen, that's their job, to fill in the gaps. But they got to know where you are in order for them to fill in the gaps. We have an arbitration mechanism, a court proceeding that allows for this lawful legal money to be leveraged. It reconfigures the entire scenario as a leverage buyout, meaning you have the ability to leverage debt on scale because you're utilizing insurance and reinsurances. So technically, and I'm leaving things out on purpose because I'm not trying to get into a solicitation conversation. I am simply giving you educational information. If you look right underneath the negative debit that represents money, if you read HR 504, like, for example, if you were to go to Google, type in, I don't know, HR 5404. I'm going to try to see if I can bring it up just so I can read this aloud so you'll understand that you're not in Congress. You guys should actually be seeing this debt clock. You may be able to see it. You may be able to see it. You can. Okay, for those of you that can see it, it's literally telling you in the whole layout what things are, what they isn't, because you're going to have to understand what they're doing. What are they doing, Mr. Bay? What are they doing? Well, what they're doing is they're telling you that to define a dollar as a fixed weight of gold, be it enacted by the Senate of House Representatives of the United States of America and Congress assembled, Congress finds the following. This is what Congress has found. Look at number 1. The United States dollar has lost 30% of its purchasing power since 2096 of its purchasing power since 1913. So right now, your dollar is only worth 3 cents on the dollar, which means if you have $1 million in a supposed and alleged M2 asset class, such as a checking or savings account, you only actually have $30,000 in buying power, because they're literally looking at not the actual fiat as having value, but the paper that is printed on, the cotton. If you weigh it up, it'll only be worth 30 grand. And they're telling you this. It is in black and white. They already know this. And this particular bill by Mr. Mooney went into effect March 22nd of 2018. It is 2019, 2020, 21, 22, 23, 24. We're at the 7-year jubilee of what they already know, and they've already implemented an accounting standard. And I'm trying to get the savables into a position where they can utilize this asymmetric information to help performers who can have the ability, who will demonstrate the ability to repay and perform. Because the system wants you to perform. But accounting is going to allow you to have your capital, your efforts rewarded. The failure to do accounting is going to be to your and your family's financial detriment. So it is essential that you understand what we are breaking down to you. See, in closing, the lenders will hold that M3 asset on their book as collateral, and they will actually finance the 1% required to give them a payment guarantee. If you want to learn more about how to literally do this, and yes, we get into the last but not least, the lender. See, when you fumble, the lenders get to do a creditor's return, which is an 8302 tax return. And that's what we also teach in the aspect of recapture recovery, how you are able to recoup $1 million in commercial energy that you can use to fund another endeavor. But these things are all tapered and tailored to trusteeship. I hope this information is an eye-opener for those of you that will be hearing this for the first time, those of you that want to get involved, those of you that are in Syntax Trust Mastery class. We will be doing an intricate series at 4 p.m. Eastern Standard Time where we're going to go over the infamous tax solver software, which will allow you to do these things you just talked about. With that, I'm going to say, as long as you guys keep doing what you're doing, we're not going anywhere. As long as you keep performing, we'll keep showing up. With that, we're going to say peace and love, family. Peace and love.